Hello and welcome to our market alert video for today, which is April 26, 2024. I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America, and we have a singular goal, which I think is a noble obligation, and that is to create as many SCWPers as we possibly can. And if you don't know what a SCWPer is, it's the acronym for Second Childhood Without Parental Supervision. That's what we call a client when they retire. We call them a SCWPer. We want them to go play and have fun and enjoy, and don't worry about all this boring financial stuff. Let us do it for you. And our website is rpoa.com. So this week we got the PCE Deflator, which is the Fed's favorite gauge of inflation. And it came in right in line, which gave people a lot of confidence because investors like to feel like they're good at projecting what's going to happen. They have confidence in the future. And if that's the case, they invest. And so the fact that the PCE Deflator came in right about where market was expecting, that was very well received. Two things from that. One is there was starting to be a growing concern that the Fed was going to actually have to raise interest rates because inflation was sticking around too long and maybe it was going up. Didn't want that. And so what we're seeing is that looks like it may not be the case. So the raising of interest rates concern seems to have come off the table. And now we're back to, are they going to lower rates in the second half of this year? We think they will, probably not before September. As you know, we've been saying that not before July for almost a year now, and that's contrary to the, I'll say, the consensus opinion, because many of the largest banks and many people were saying we're going to get 7 rate cuts this year starting in March. And as you know, that has not happened. So one of the biggest risks that we face right now, which could cause a significant market correction, maybe even a crash, is the possibility of stagflation. And if you don't know what stagflation is, it is actually way worse than inflation. Okay, stagflation is inflation, but also coupled with a stagnant economy. Okay, so what that means is the Fed raises interest rates, and the economy slows down, it goes into a recession, but inflation doesn't come down. And now we've got stagflation. And the problem with stagflation is that it feeds on itself. And what it does is it's a spiral that goes down into the abyss and could cause the economy to crash. And it's a terrible thing. And it's very, very difficult to get rid of it once it starts. It's happened once in our country back in the 80s, but it's happened in other countries where it literally took down their economy. So that's one of the biggest risks potentially that we face here with this inflation that doesn't seem to want to go down anymore. It's kind of stuck, and these interest rates that are relatively high and have not gone down either. So that risk certainly is out there. Now, will it happen? We don't know. What we do know is we have a strategy to address it, and we call it invest and protect. We believe that anybody who is over 50, who is retired or who is retiring soon, should have a strategy to protect against a big bad down in the market. We think that's the biggest threat you have to your financial well-being. Worse than inflation, worse than income taxes, as bad as those guys are. And so we believe you should have a strategy to address those kind of things. Our strategy, Invest and Protect, told us to sell in November of 2007 before the big stock market crash of 2008. We actually told our clients to stay out until June of 2009, so almost a year and a half. We were in cash, recommending to be in cash and not participating in the big bad crash that happened in 2008. We anticipate there'll be another crash at some point in the future. Our strategy is designed to help us with that. If you don't have that, then we think you're potentially at risk. Okay, we still have a positive outlook for this year. We think the stock market should do well. We think the bond market is going to go through the roof the moment we see the Fed start lowering interest rates. So the outlook is positive, but we always plan for the worst and hope for the best. We don't plan for the best and hope the worst doesn't happen. We don't think that's prudent either for us personally, for me personally, or for our clients for that matter. So anyway, that's where we are. We're still positive outlook for this year, but always make sure you have a strategy to protect yourself in case we're wrong, and we could be. So thank you for watching this video. Our website again is rpoa.com. Go there and you'll see all kinds of resources that we have for you if you are in that demographic of over 50, retired or retiring soon. So thanks for watching, and we will talk soon.